We need to be patient and let the restrictive policies do their job. It's very difficult to find out some dove notes in this statement. On the contrary, the hawkish tone over these comments pushes the time for turning monetary settings even further to the end of 2024 or even to the beginning of 2025. As we see, Jerome Powell suddenly toughened his rhetoric, and after a series of statements about the need to start cutting interest rates, he announced that they would apparently remain at the current levels for a long time. Besides, the Fed Reserve Chairman noted on Tuesday that the producer price index in April was higher than anyone expected. As can be seen from the chart above, producer prices in the US have been rising for the fourth month straight. The annual PPI stands at 2.2% in April. Moreover, in April, factory inflation turned out to be higher than expected. PPIs for March were sharply revised downwards. But despite these contradictions, the inflation forecast published today were also upgraded. Will the latest economic data be able to finally highlight the issue of a possible rate cut in the United States? The consensus on inflation suggests that the annual CPI will remain flat at 3.5% in April. Importantly, the significance of today's report is much higher than the factory inflation data released yesterday. Like any high-impact event, the inflation report pushed trading instruments to move in the opposite direction from a forecast. Reports of a high inflation in the United States will be an impetus for the dollar to rise. Meanwhile, amid the current dip in the greenback, investors are getting ready for its growth later today, and the US dollar might develop an impressive rally. On early Wednesday, the US dollar index was trading in the bearish zone of 104.80 to 105.10. Moreover, the index had been losing ground for the third session in a row. During this time, the US dollar weakened across the board, but depreciated the most against the Australian dollar and the New Zealand dollar. These currencies partly benefited today from the growth of the yuan, as the People's Bank of China forged ahead with its efforts to prop up the national currency. As for the Chinese economy, it continues to sag in the real estate and finance sectors. Moreover, trade data for April showed a significant increase in imports. However, Beijing faces troubles here. US President Joe Biden has unveiled a package of sharp tariff hikes on a range of Chinese imports, including electric vehicles, computer chips, and medical products. For example, tariffs on electric vehicles are likely to rise 300% from the current 25%. Wall Street has shrugged off mixed factory inflation data and hawkish signals from Jerome Powell. As a result, the rally in the shares of large technology companies brought the S&P 500 index to levels close to all-time highs. Futures on the S&P 500 traded higher in the range of 5,217 to 5,250 points on early Wednesday. The euro-dollar pair also tested a new one-month high at about 1.2828. At the same time, market participants managed to prolong the current correction, which was accompanied by a flood of euro buyers. The euro bulls are winning today because the market has always been fond of speculation. After all the above-said arguments clearly indicate that the Fed Reserve will delay its monetary easing until the last minute, unlike the European Central Bank, which is ready to do this in less than a month on June 6. But today, during the European trading session, the pair may rise a little more within the daily range of 1.2817 to 1.2838. From the point of view of a technical analysis, stable price retention above the level of 1.2800 opens the way for further growth of the euro. However, if the price returns below this level, it could indicate that the peers are back in the game. During the European session today, the euro-dollar pair may rise a little more within the daily range of 1.2817 to 1.0838. From the point of a technical analysis, if the price settles above 1.2800, this will open the way for further growth of the euro. However, if the price sinks below this level, it could indicate that the peers are back in the game. In the industrial production report for the Eurozone, the rate of decline is likely to slow from a minus 6.7% to minus 2.2% on a year in a notch. While the euro is consolidating ahead of a crucial statistics from Europe and the United States, news from Canada and the Middle East is fueling commodity prices, and this time we are talking about hotspots in the literal sense, as large forest fires threaten Canadian oil facilities. In addition, US crude oil inventories contracted by 3.1 million barrels last week. Therefore, the Brent price is trading higher today in the range from $82 to $84 per barrel. All in all, crude oil has been locked in this trading range for 2 weeks in a row. That's the market is still in equilibrium. Expectations that the Federal Reserve will go on with its tight monetary policy do not allow oil prices to move higher. On the other hand, investors fear that a further slowdown in inflation will force Russia and Saudi Arabia to revise the production quotas. Both of these factors cancel each other out of prevent the oil market from moving because of the current balance of trading called equilibrium. Meanwhile, it's difficult to say what exactly can bring the market out of this stagnation. The current rate can be viewed as a process of trading forces accumulation of a possible speculative swings. You have watched the Market Review by InstaForex analyst for Wednesday, May 15. Subscribe to InstaForex TV channel and we keep you updated on all market developments. Feel free to ask any questions and leave your comments. So see you online tomorrow.